The question everybody is asking, will the Fed raise interest rates again in September, even though we are already in a technical recession? Welcome back to the Bitcoin Layer, everybody. Today, I'm going to break down what I think is going to happen at the September FOMC meeting. First, we're going to talk about what's happened so far in monetary policy this year, some reasons why the Fed should hike interest rates in September, some reasons why the Fed should pause its hiking cycle in September, and finally conclude with what I believe is actually going to happen at the Fed meeting. Now, the first 250 basis points of interest rate hikes that we've seen in 2022 were very easy to forecast given where inflation had reached in this country. So CPI was starting to creep above 5%, and by that point, we really knew that the Fed was going to hike interest rates and try to slow down inflation. Inflation is now all the way at 9%, but the Fed had committed to at least 250 basis points of hikes well before inflation ever got to 9%. So for this reason, we know that this first 250 basis points of hikes was going to happen. We are less sure, however, about the next 50 basis points of hikes, whether or not that's going to happen. Let me explain why. Now, there really are factors contributing to both points of view, whether the Fed should hike or whether they should pause. The first reason that they should be hiking rates in September is CPI inflation. This is the headline inflation number, the consumer price index, and we see it today over 9%. This is, once again, at multi-decade highs, and the Fed is most concerned about out-of-control inflation. With an inflation target at 2%, inflation at 9% is basically out of control from the Fed's perspective, and it has to put the brakes on that number, first and foremost. Why is the Fed so concerned about the difference between CPI and its inflation target of 2%? It comes down to the Fed's reputation. The Fed is tasked with price stability. That means the Fed is tasked with not letting prices in dollar terms get out of hand. Well, 9% inflation, when wage inflation is only at 4 or 5%, means people are losing money every day, even though they're getting raises of 5% in nominal terms. This is a problem for the Fed, and if the Fed wants to show that it does actually care about the inflation impact on Americans, it must show that it's trying to restrict economic activity in order to bring inflation down. That is its most important task right now. Let's talk really quickly before we move on about this reputation factor here. The reputation of the Fed is important to the Fed because let's look at what has happened for the past 10 to 15 years in monetary policy in this country. We have seen the Fed create trillions of dollars of reserves in quantitative easing programs that has destroyed a lot of its credibility with the public. The public believes that the Fed is only there for bank bailouts and devaluing the dollar. And the Fed really does feel the impact of this sort of backlash towards it for its many years of quantitative easing. Now, the Fed has to do the opposite during periods of inflation, which a lot of people believe is the result of all of this quantitative easing. Now, I don't necessarily believe that today's inflation is directly 100% caused by all of the QE that we've seen over the last many years. In fact, most of it is likely due to the impacts of this once-in-a-century pandemic and supply chain disruption. But that doesn't mean the QE that we've seen for the last 10 to 15 years hasn't contributed to today's inflation. It absolutely behaviorally has contributed to the inflation that we are seeing today. It just so happens to be that the pandemic is what triggered the inflation, and right now, inflation cannot be tamed very easily just by raising rates a little bit because it has been unleashed, and it is a valid argument that years and years and trillions of dollars worth of quantitative easing has contributed to all of this inflation that we're seeing today. For this reason, the Fed is trying to protect its reputation, raise interest rates, and bring down inflation. It wants to do the opposite of QE, which is ultra loose monetary policy. It wants to have tight monetary policy to show the public it can actually be restrictive. A second reason that the Fed should hike interest rates in September is that the stock market is doing pretty well. Now, I know we had a deep bear market in risk for the first half of this year. Stocks actually crossed the 20% down threshold. We all know Bitcoin was down 75% from its peak, but the stock market rallied significantly off of the levels that we saw in June. The stock market had its best month in July versus the last couple years, and we see that the stock market isn't collapsing. The Fed is actually very sensitive to the level on stocks, especially now that stocks had already come down 20%. The fact that stocks have bounced here gives the Fed a little bit of permission to hike. If stocks were in utter collapse, we wouldn't see the Fed trying to get too tight with monetary policy, and we might see that as more of a reason to pause. But right now, stocks are doing just fine as they've rallied over 10% off of the bottom. Now, let me give you a few reasons why I believe the Fed should pause in September. So the upper bound of the Fed policy rate right now is at 2.5%. I believe that to be fairly restrictive. We also know that monetary policy has effects with a 6 to 12 month lag, which means that when the Fed hikes interest rates, only 6 to 12 months later will we feel that tightening. So the hike that we saw in March is only being felt in the next few months. The hikes that we saw last month in July won't even be seen until January of next year at the earliest. So it would make sense that let the Fed wait a little bit here as it's raised rates to 2.5% already. We want to see what effect that is having on the economy. Now, when we look at real estate, we can see that it's already affecting real estate in a significant way. Homes are staying on the market longer, sales are slowing down, prices are going up at a decreasing rate, and we see anecdotally that activity has slowed down a lot across the country from a housing perspective. So the basics that the Fed should wait a little bit now that it's hiked rates 250 basis points is a valid one. Next, we are in a technical recession. We had negative growth in the first quarter and negative growth in the second quarter on GDP. That is a technical recession, 2 consecutive quarters of negative GDP. And with the Fed looking at a technical recession, hiking rates again in September, looks like the Fed wants to actually step on the neck of the economy and not just slow down inflation. So I think that's a reason, the fact that we are in a technical recession, that's a reason that the Fed should pause in September. Another reason the Fed should pause in September, the absolute collapse in the yield curve. This is the difference between 2-year and 10-year Treasury yields. We can see the deep inversion of the curve right now. That is the market signaling to the Fed that growth and inflation expectations over the coming decade are lower than the policy rate expectations over the next couple years. That means that the Fed is actually choking off growth from the economy as the 2-year yield is materially higher than the 10-year yield. We always see recessions follow this period of deep inversions, and this is no different. We've actually already confirmed it, that the inversion of the yield curve has corresponded with a recession in this country. One last factor that the Fed should pause in September is the 5-year inflation swap. This is the expectations for inflation starting in 5 years from now. This is the metric that the Fed uses to watch what inflation expectations are from the public. You can see on this graph that inflation expectations are sticky at about 2.5%. This means we're not seeing runaway inflation expectations whatsoever, even though spot CPI is at 9%. We also are not seeing a real collapse in inflation expectations. Right now, they are steady at about 2.5%. This, to me, means that the Fed has actually already done its job and tightened monetary policy enough to slow down runaway inflation expectations. This is cause for the Fed to say, hey, we've done enough right now. Inflation expectations starting in 5 years are stable. They're not running out of control. We should pause our hiking right here. What is my conclusion? What is my prediction for the September FOMC meeting? Right now, I believe we are going to see a 50 basis point interest rate hike at the September meeting. I'll explain why. The first reason is, as a rates trader, I always watch the rates market. And I know from experience that money market rates looking 30 to 60 days out are basically never wrong. We all know that predicting the future is basically impossible, and making forecasts really beyond any time horizon in the market is very difficult to do. But when it comes to money market rates and the expectation of what the Federal Reserve is going to do, so specifically Fed Fund futures, these are the interest rates on expectations of where the Fed's policy rate is going to be, they're basically never wrong once we get inside 1 to 2 months of the final date of the contract. So right now, the Fed is expected to hike 60 basis points or more at the September meeting based off of the Fed funds futures curve. We like to use WIRP, which stands for World Interest Rate Probability. It's a screen in Bloomberg, which pulls up the Fed fund futures curve and shows us exactly where the market believes that the policy rate is going to be on that date. Now, WIRP screen, again, like I said, it can fluctuate a lot when you're looking 6 to 12 months forward, and sometimes it can be way off today versus what actually happens in 6 to 12 months. But when you get inside that 1 to 2 month period, it isn't wrong. It actually does end up predicting what the Fed is going to do. Why does this happen? The Fed is not here to shake the market too much. The Fed communicates to us every single day through its press conferences, through its reaction to markets, and through its official releases what it wants the market to think. It depends on traders to position the portfolios and to position money markets accordingly to make sure that when the Fed does raise rates by 50 or 75 basis points like it did in July, that markets are not disrupted. So right now, with over 50 basis points priced into September, I do sincerely believe the Fed will not upset that dynamic, and we will see another interest rate hike in September. This also means that the marginal tightest in monetary policy for this cycle is over. The last 2 interest rate hikes were 75 and 75. If this one does go down to 50, it means that we are finally on the easing path. We are still, even though we're still tightening, the easing path is before us. And that is why I believe risk assets have bottomed. And we see that risk assets have performed quite well since June and had a tremendous July. Where could this go wrong, this thesis of the Fed hiking again in September? If interest rates come down faster than I expect, meaning that if interest rates come down and 2-year yields, for example, fall below where Fed funds is today at 2.5%, that would be the market signaling to the Fed that growth is slowing significantly, inflation is falling really quickly, and the Fed doesn't need to hike anymore. I don't believe that's going to happen, but that is where we should look. We should look at the relationship between 2-year yields and Fed funds. The crossover, meaning when 2-year yields fall below Fed funds, that is when the Fed will pause its hiking, and I don't believe that will happen before September. Therefore, we will see another 50 basis point interest rate hike in September. Thank you for sticking with me. Subscribe to the channel. Make sure you like this video, and we'll see you next time here at the Bitcoin Layer. I want to thank my sponsors, Zebedee and Voltage. I'm really excited about partnering with Zebedee. They are building what I believe is a really important user experience for people that are onboarding to the Lightning Network. Now, Zebedee is a company focused on the gaming industry, so how does that fit in with global macro? Well, you guys know how much I believe in the Lightning Network, And I believe that what Zebedee is doing is it's introducing the Lightning Network to people in a way that makes them understand why instantly transacting Bitcoin is so important. So check out our Lightning address, the Bitcoin layer, at zebedee.gg. Go download their new wallet for a great first Lightning Network wallet and get your own Lightning Network address. I'm proud to have Voltage as the sponsor of my Substack. Voltage is powering businesses to be able to run their own nodes, both Bitcoin and Lightning Network. I'm really excited about working with Voltage because I believe they are powering some of the most important businesses in the Lightning Network ecosystem already. Go check them out.